Good afternoon, I'm Mark Wheatman. I'm CEO of Vunani Private Clients. I have the pleasure today of taking you through portfolio diversification, how to construct a portfolio. So let's launch off. Let's start off by how to create a diversified portfolio. So that the starting point is to have a mix of shares, bonds, properties and cash. And this is known as your asset allocation. A lot of studies out there that show that between 77 and 94%, so the vast majority of your portfolio's returns are determined by what asset class you're in, not necessarily what stocks you pick. So it's generally agreed in the industry that this is the hardest part of creating a portfolio, and that the stock picking side is actually a lot easier. So in order to diversify, you need to know what kind of investments you want to buy, how much you want to put into each one of them, and what investment category or asset class that you want to be invested in. It's all about not having all your eggs in one basket. So having a lot of investments doesn't make you diversified. So having 100 shares in your portfolio is not necessarily a diversified portfolio, because you could have 100 of the same type of shares. So what we want to do is we want to go for variety and not necessarily quantity. So you can be diversified by having 18 to 20 shares and different asset class, bonds, cash, properties, as long as they all look a little bit different. So to be diversified, you need to have lots of different kinds of investments. So that means we want some shares, we want some bonds, property, and international securities shares. So often I get asked, Mark, I understand. How do I split up this? I understand I need to be diversified, but how do I split up this investment pie? So I'm going to take you through the four main asset classes. First one is cash or cash substitutes. You understand that. That's a bank account that pays you interest. It's not going to keep up with inflation, not going to give you a very high yield. Next one up the risk spectrum, bonds. Typically government bonds. These give you the income, that yield part, that little bit of cash every month. Tend to be low to medium risk. Next one up in our asset class is property. This gives you a correlation against equities because it doesn't necessarily match equity performance. It's got a low correlation to shares, medium to low risk, and it gives you a bit of yield, and it gives you a little bit of capital appreciation. And the last one in your portfolio should be shares. I mean, this is literally the engine house of your portfolio. This is going to give you a capital growth and some dividends. And within those shares, you should look to take a sizable portion of your money offshore to protect yourself against the currency, any rand currency depreciation. So we typically take about 20-25% of our equity component offshore. Always remember, when you build a portfolio, it's about your time horizon. If you're going to be in the market a very short period of time, you want something that's liquid. You want to be able to get out of it. So you tend to have very liquid shares, or you tend to be in cash if you've got a short time horizon. If you've got a long time horizon, then you can put a whole lot of things that you can keep for a long time in your portfolio. Also, you need to have a look at your appetite for risk. Typically, I like risk. I tend to put shares that are kind of sexy, kind of aggressive, make me a lot of returns. Might not suit your risk profile. So have a look at yourself, do some introspection, decide how much risk you're willing to take on, and then match the shares to that. And then, do you need income? If you're older in your life and you need to live off the income from your portfolio, you need to have dividends. You need to have bonds in there for yield. You need properties with decent yields on them. So look at what the income component of your portfolio is. You know, life is about risk. It's a risk-return trade-off. So the younger you are, the more risk you can take. So I'm middle-aged. I'm sort of in the middle of the risk spectrum. So let's have a look at this risk-return trade-off that I've done for you here. And depending on where you are in your life cycle, you can either take more or less risk. So if you're young, let's say younger than 30, you can look at a CPI plus 75% in equities, very, very high expected return, but you're taking on a lot of risk. If you're older, 65, 70, you should look to be on the left-hand side of this chart. You want to take on less risk. You're probably looking at CPI. CPI is, of course, inflation. So inflation plus 3%. So you'd be looking at about making a 9% return at the moment, and that would have about 40% in shares. So you need to look on this chart, find out where you'd position yourself. So the next question I want to deal with is, I often get asked, should my portfolio change over time? And clearly it should, because as you get older, your appetite for risk and the time that you're going to be in the market, it becomes shorter and shorter. So as you get older, you want to take on less risk, and you want to restructure it. Now, there's always been, in the old financial planning world, there's always been this rule of thumb, which says minus your age from 100, and that tells you how much shares you should have, percentage shares you should have in your portfolio. So if you're 30 and you minus that from 100, you should have about 70% equities in the market. Now, the problem with these rules of thumb is they tend to change because people are living longer. So what we tend to say to clients nowadays, rule of thumb is minus your age from about 110 to 115. So if you're 30, you should have about 85% equity exposure in the markets. And as you get older, so if you live to 100, clearly you should be in cash. Very little equities in your account. So that's a rule of thumb, but you should be a little bit more scientific than this, but you can use that as a starting point. So I want to give you, to end off, I want to give you a portfolio, a model portfolio that we use. This is a very, very medium risk. So this would be for a client who's maybe sort of 45 to 50. And I want to talk you through the different parts of that portfolio. So the smallest part is cash, 5%. You always need cash to live off, just in case you have some spending requirements. You want to take that holiday, you might need to dip into your portfolio, buy your son a car. Next up is bonds, 14%. You need those bonds. They're going to give you some yield. They're going to give you some safety. They are government backed. Then we have property, 21%. That gives you a bit of capital appreciation, gives you yield from your property, so a bit of income there. Alternative investments. Now, alternative investments could be hedge funds, could be gold. You could have some gold, platinum, commodities in your portfolio. So we always tend to have a sliver in there because they're non-market correlated, gives you that little bit of extra returns in your portfolio. Also spices it up, makes it a bit interesting. So that's 5% in alternative investments. Then offshore, at least 17.5%. Potentially more. Depending on your view on the rand, you might want to take this up to 20, 25%. But in our model at the moment, we've got about 17.5%. And then the largest and the biggest component is equities, domestic equities. These are shares listed on the JSE. Don't have to be shares. You could go into unit trust. You could go into exchange traded funds. We tend to buy shares, individual shares. So these are the Anglos, the Sassels, the SA Breweries of the world. So we're going to spend about 37.5% of our portfolio on this. And this, as I've said, is the engine house. This will make you all your returns and your capital appreciation. So hopefully that gives you a little bit of insight into how to build a portfolio, how to create that nice diversified portfolio that will live with you throughout your life. I'm Mark Wheatman from Vunani Private Clients. Thank you.